Welcome back to the channel. I'm Algabot, your guide to the mechanics behind automated trading systems on MetaTrader 5. Today we're studying an expert advisor called the Guppy Compression Breakout. It's a trend-following, reignition system built on Daryl Guppy's multiple moving average, a tool that plots two separate groups of moving averages to reveal how short-term traders and longer-term investors behave relative to each other. Over the next few minutes, we'll explore what this strategy watches for, how it decides to join a resuming trend, and how it manages risk. Everything here is educational information only, so let's dig in. Let's start with the big picture. The Guppy Compression Breakout is designed to rejoin an existing trend after a brief pause, rather than to guess at brand new turning points. It reads the market through the Guppy Multiple Moving Average, often shortened to GMMA. This indicator plots two clusters of exponential moving averages on the closing price. The first cluster is a short group, using periods of 3, 5, 8, 10, 12, and 15. Guppy nicknamed this the traders group because it reflects the fast-moving crowd. The second cluster is a long group, using periods of 30, 35, 40, 45, 50, and 60. That's the investors group, the slower, steadier money. The insight behind this tool is that no single line matters. What matters is the behavior of the two groups relative to each other. When the two groups are cleanly separated with the short group on top, the trend is considered healthy. During that trend, the trader group periodically compresses, meaning its lines bunch tightly together as a small countertrend pullback drains conviction. Then it fans open again as the fast crowd recommits in the direction of the slower investor group. This strategy is built to study that specific squeeze then fan open moment as a continuation signal. To make the compression and expansion measurements consistent across different symbols and timeframes, the strategy measures the internal width of the trader group from its highest line to its lowest line and divides that by the average true range. This normalized spread lets the same threshold settings work whether you're studying a currency pair or a metal. The defaults point toward a trending foreign exchange major or a metal such as the euro-dollar or gold on the 1-hour or 4-hour timeframe, though it is timeframe agnostic. In terms of who this style suits, it's aimed at those who want to understand systematic, rules-based trend continuation logic. As always, trading involves risk, losses are part of the process, and nothing here is financial advice. Let's walk through the exact logic, one condition at a time. The expert advisor acts only once per newly closed bar, so it isn't reacting to every tick. On each closed bar, it recalculates both Guppy groups and the average true range. For a long setup, several conditions must line up together. First, the investor group must be rising. The strategy measures this as the change in the long group average over a number of bars set by the slope bars parameter, which defaults to 5. Second, the short group average must sit above the long group average, which the code calls bullish alignment. Third, the trader fan must have recently compressed. The strategy looks back over the CompressLookback window, 6 bars by default, and checks whether the normalized spread dipped below the compress threshold of 0.50 at any point. That's the squeeze. Fourth, on this very bar, the fan must freshly expand, meaning the normalized spread crosses up through the expand threshold of 0.90, having been at or below it on the prior bar. Finally, the short average must tick upward, and the close must finish above the short average. When all of that is true, the EA signals along to join the resuming uptrend. The short setup is an exact mirror. The investor group must be falling. The short average must sit below the long average for bearish alignment. The trader fan must have recently squeezed, then freshly fan open downward through the expand threshold this bar. The short average must tick down, and the close must finish below the short average. Risk management is average true range based. On a long, the stop is placed the ATR multiplier times 8ER below entry, defaulting to 1.5 times ATR. The target is set at the reward ratio times that stop distance, a default of 2, giving a 2-to-1 reward to risk framework. Shorts use the same distances mirrored above entry. There's also an early exit. If the two Guppy groups cross against an open position, the alignment has flipped, and the strategy closes the trade rather than waiting. Only one position per magic number is allowed, so trades never stack. Let's read the code as it appears in Meta Editor. At the top are the inputs. CompressThreshold and ExpandThreshold define the squeeze and the fan open on the normalized spread. CompressLookback is how many recent bars we search for that squeeze. Slope bars measures the investor group's direction. ATR period feeds the volatility calculation, and the ATR multiplier and reward ratio shape the stop and target. Just below, two guards must pass before any trade. The variable fresh fan open is true only when the previous bar's spread sat at or below the expand threshold and this bar's spread rose above it. Combined with recently squeezed, this insists on a genuine squeeze followed by a fresh expansion. Now the long block. The condition checks bullish alignment, that the short average ticked up versus its prior value, and that the close is above the short average. When true, the entry is taken at the ask. The stop is placed the ATR multiplier times ATR below entry. The risk is that distance, and the take profit is the reward ratio times the risk above entry. Then trade up by sends the order. The short block is the mirror. It checks bearish alignment, that the short average ticked down, and that the close is below the short average. The entry uses the bid. The stop sits the same ATR distance above entry, and the target is the reward ratio times that risk below entry, sent through trade.cell. Let's walk through this illustration candle by candle. On screen you can see the two Guppy groups. The gold line is the trader group average, and the pair of gray lines above and below it mark the top and bottom of the trader fan. So the gap between them shows how wide or narrow the fast crowd is. The blue line is the slower investor group average. On the first two candles, price is drifting upward and the gold trader average is holding above the blue investor line. That's the bullish alignment the strategy wants, with the fast crowd leading the slow money higher. Notice the investor line is gently sloping up, confirming the underlying trend is intact. Now watch the third and fourth candles. Price stalls and pulls back slightly, and the two gray fan lines pinch together toward the gold average. This is the compression, the squeeze. The fast trader lines have bunched up as the small countertrend pause drains conviction. The strategy records that the normalized spread has dropped below the compressed threshold. This is the coiling that the whole setup depends on. On the fifth candle, which is our buy entry marker, the fan springs back open. The gray lines spread apart again. The normalized spread crosses up through the expand threshold, the gold average ticks higher, and price closes back above it, still above the blue investor line. Every long condition is now satisfied, so the EA signals the buy entry you see marked. The stop is placed an average true range distance below, structurally sitting under the recent squeeze, and the take profit target is set at the reward ratio of 2 times that risk distance. Follow the next candles as price reignites in the trend direction. The trader fan stays wide and stacked above the investor line, and by the 8th candle price reaches the take profit marker. That's the long trade closed at its target, capturing the continuation leg after the squeeze. Now the character of the market changes. Around the 9th and 10th candles, price rolls over and drops, and the gold trader average bends down toward the blue investor line. The investor slope begins to flatten and then turn lower. On the 11th and 12th candles, watch the gray fan lines pinch together once more just under the highs. This is a second compression, but this time it is forming on the weak side, with the crowd hesitating as the trend tips over. On the 13th candle, our sell entry marker, the fan opens downward. The gold trader average crosses below the blue investor line, giving bearish alignment. The normalized spread crosses back up through the expand threshold as the fan flares open, the short average ticks down, and price closes below it. The mirror image short conditions are met, so the strategy signals the sell entry shown. Here the stop sits an average true range distance above entry, and the target is again the reward ratio times that risk, projected below. Price then slides lower through the final candles, the fan staying wide and stacked below the investor line, until it reaches the second take profit marker on the last candle. That completes the short trade at its target. Notice how in both cases the strategy waited for a squeeze first and only acted when the fan freshly reopened in the trend's direction, which is the essence of this continuation approach. So that's the Guppy Compression Breakout. We covered how it reads the market through two groups of moving averages, how it waits for the trader fan to squeeze and then freshly fan open in the direction of a trending investor group, and how it frames every trade with an average true range stop and a reward to risk target. exiting early if the groups cross against it. Remember, this video is educational content only and not financial advice, a recommendation, or a solicitation. Trading carries real risk, and losses are a normal part of it. If you found this breakdown helpful, please like the video, leave a comment with the strategy you'd like analyzed next, and subscribe for more MetaTrader 5 strategy studies. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.